Welcome back to Markets with May. In this episode, we're going to talk about yield curve inversion and what does it mean for the 2 and 10 year to be inverted. Now, from time to time, I get questions about the bond market and interest rates and U.S. Treasuries and what's it all mean. And more than any other time, I've had people specifically ask me about the inversion of the 2-year and 10-year and whether that meant we were going into recession. And I find it very, very interesting because last year, the big question in everybody's mind was the fact that if interest rates were so low, that was a certain thing that was going to be horrible for the equities markets, and it just wasn't. And the reason I would give everybody was, I don't really care how low the rates go. I really only care that that thing remains steep. Any other shape other than steep, of which the yield curve could make many different shapes, kinked, twisted, etc., and then we have a problem. And now everybody is looking at the 2-year and the 10-year. They're listening to CNBC and they're hearing this news that we're going into recession for sure because that's what the inversion of the yield curve means. And I'm like, let's actually discuss that a little bit further. So in this episode, I'm going to talk about one, what does the Fed actually look at? And then I'm going to talk about what does it mean for the curve to have the 2-year and 10-year invert? And what maybe doesn't it mean? And then the third thing I'm going to talk about is who looks at the 2 and 10 year and why. And then I'm going to go through the entire yield curve and talk about what each part of it would indicate as relates to who and what is impacted. But before we get into that, I would be so grateful if you would like, share, comment, or just hit the subscribe button above. It always helps me know what types of things are interesting and what other types of videos I should do. Now, let's get into this whole yield curve stuff. Now, I could tell you whatever I think it is that the Fed looks at as relates to the yield curve, and I know I'll have comments full of haters. So I just as soon have the Fed chairman tell you himself. And he answered this question at the NABE meeting.
Is the Fed concerned at all about the yield curve actually inverting? And if it were to invert, would it impact the pace or magnitude of rate increases?
So we monitor, as I mentioned, a broad range of financial conditions. And the shape of the yield curve is just one thing. We do look at that. And we look at different measures. And frankly, there's good research by staff in the Federal Reserve System that really says to look at the short, the first 18 months of the yield curve, right? And that has 100% of the explanatory power of the yield curve. And it makes sense because, there's a reason why that would be the case. Because if it's inverted, that means the Fed's going to cut, which means the economy is weak. 2s to 10s, it's hard to know why that would. They started to have some economic theory of why that would be, why that would make sense. We of course look at it. I mean, I won't tell you I don't look at it, but I do. I think. Actually, I tend to look at the shorter part of the yield curve, though. And again, it's just one of the many things that we look at.
Now, in fairness to the folks that are laser focused on this and have put videos on this topic as well, there was a white paper that was produced by the Chicago Fed that discussed the relationship between the inversion of the 2s and 10s and its predictive potential on recession. And for those of you that are subscribers to my paid channel, you will have access to that through the Discord, and I have put a link in the Discord. The point that he's clearly making in this meeting is that although, there is something with the 2 and 10 years, it's really the first 18 months that have 100% of predictive power, and the causal reasons for why that is are very straightforward. So there's really no need to look at the 2s and 10s in particular if what you're trying to determine is whether or not there's a recession or whether there's some kind of major issue going on. Just to be clear, it's not that the 2-year and 10-year inversion doesn't correlate heavily with recession. It's more that if you take a closer look and you look at that first 18 months, you'll see that what's actually happened is the first 18 months skewed into inversion. And then the 2s and 10 years, just by virtue of being the rest of that tail and by virtue of what it means for that front part to do that, also will show inversion. So it's just that you've looked at farther down in the curve and you're kind of potentially missing the more important part, which is those first 18 months too. Some folks responded with, but May, all the portfolio managers look at it. So of course it has some kind of maybe secondary effect on the bond marketplace. And my answer to that is, well, kind of. So For a lot of the portfolio managers, they are taking a thing called duration risk, or alternatively, they're trying to hedge out duration risk. Or a third option is they do have a very specific opinion on what's going to happen with 2-year debt versus 10-year debt. And this might be related to refinancing that's happening. This might be related to the types of loans that are specifically at the 2-year mark versus the 10-year mark. It can be due to a lot of different things. Now, I'm not saying that it's something they would completely disregard. And certainly if they were trying to give a quick presentation, because the data is pretty good for the 2 and 10-year, if they were just trying to show the steepening of the yield curve or the flattening of the yield curve, which is what the 2 and 10-year is doing, and if they were trying to show it particularly in that section of the curve, it would be a really fast way to do it. Now, the last thing that I want to discuss, just to clarify this yield curve, because I feel like sometimes there's so much mystery surrounding it. What actually is the 2-year and 10-year as relates to who's lending there versus at the 10-year? And how might we then just want to think about that from the perspective of when it inverts, what could possibly go wrong or what could happen? Well, I created this a few weeks ago on my daily show because the question just kept coming up over and over again. And it's not designed to be perfect or to discuss all the types of debt that happen at each of the different vintages of the yield curve. But what I wanted to say to that was that in the front part of the curve, this part is the most important for liquidity because it governs short-term debt rates and whether or not it's profitable for a bank to lend. That's why when the front part of the yield curve inverts, it's not so much a recession as a really, really big problem. Because what will happen to banking liquidity is you'll see it, if it persists or if this steepness of the inversion is great, you'll see the liquidity come straight out of the marketplace. So one of the periods that was technically not a US recession because we continue to grow, but absolutely was such a massive concern that the US began lowering rates in anticipation of just trying to help things out globally, was the Asian crisis of 1997-98. Now, there's a lot of global interplay and global dynamics that goes into that quite frankly is very relevant for now, but it's beyond the scope of this video. What I can say is that a lot of the yield curves overseas started to invert aggressively such that the front end went all the way to the moon in an effort to stave off capital flow out of a bank. And so that's really more or less a real problem that you would find in that first 18 months. That's because what the yield curve is telling you is what am I willing to give in the way of a rate given the amount of time you're going to be holding my money, so to speak. So it would follow that if you're going to hold my money for a day, I'm going to charge you less than if you're going to hold my money for a month. If I'm going to hold my money for 3 months, if you're going to be holding my money for 30 years, I need some more than what I would need if you were only holding it for just a day or so. So when the yield curve inverts at the front end, what they're saying is that, hey, I need more money for you to hold it for a day than I do if you're going to give it back to me in 30 days, which is weird if you think about it. And the only reason that might be the case is you need that money today because you need that money today. The same way that it would be the case that if you had to pay rent, but you weren't getting your check for 2 weeks, you might actually have to borrow money and be willing to pay someone to give it to you right now so you can pay your rent versus in 30 days. The whole world kind of works the same way. So when that yield curve inverts where short-term money is worth a lot more than long-term money, in that first 18 months, we're going to get to the 2 to 10s in just a little bit. In that first 18 months, then that is a real serious problem. And that actually happened in a lot of the different countries that had rate issues in 97, 98, 99, that sort of thing. Now, right now, the global economy and the geopolitics is very uncertain. It's something we've talked about on our daily show for some time. And in that regard, raising rates to give us potentially some cushion if something happens overseas and tries to come in is a really good idea. And the reason it's a really good idea is that's kind of what we did in 97, 98, if you look at it very closely. And that allowed us during that period of time to still have some positive GDP growth, but the jobs market took a hit during those years of Asian recession in the US. So it's worth taking a look at what happened economically during that period of time in case you're trying to understand what's going in the forward events. Now, banks always borrow forward, by definition, because with your deposits, a lot of folks have time deposits where they get an interest rate. So basically they're taking in your money, they're giving you back some kind of money market rate, and then they lend it out farther down the curve. So the first 18 months matters a lot. In that first 18 months, there's some specific people that they're lending to. In particular, in the first 6 months, there's a portion of the market called the factoring market, and that deals a lot with consumer purchases. So if you're a middle-sized mom and pop shop, you might go to a bank and say, hey, I'd like to factor my receivables, or I'd like to factor something that I know I had this much sales next year and my projections are this. Factoring is a real part of what allows the supply chain to work. And if you were to have in the front part invert, it would sock it to the supply chain pretty aggressively. So that's not what we want, and we definitely want to be very careful to see that steepen, which it has.
Now here you can see the most recent yield curve numbers off the Fed website. And what you'll notice is that the 2s are trading slightly below the 10s. But more importantly, you can see that there are other places where there's a little bit of a peak. So for example, the 5s and 7s are above the 10s. And so that's what I'm really illustrating. Additionally, more importantly, the front end of the curve in the second 2-year is at 250 basis points. That typically would indicate the ability of banks to make really great net interest margins and be a positive signal as relates to liquidity in the marketplace.
The 2-year and the 10-year rate is a little bit of a different animal. And again, this is not meant to be inclusive of all potential loans at 2-year rate, but typically the types of loans we'll see at 2 years is something that's a very specific type of project financing, or alternatively, and most commonly, construction loans are done at 2 years. At the 10-year rate, you do see a lot of corporate debt. Now, when we go to compare the 10-year to the 2-year, it's a little bit awkward. 10-year debt typically is corporate debt. It also can be commercial real estate debt. And it would make sense that you would see decline in the 2-year for construction loans because no one's doing construction right now with inflation. And then the 10-year, there might still be demand there that would bid up the interest rate. 2s and 10s, there are people that borrow debt at the 2-year and lend it at the 10, but they could also borrow the 2-year and lend at the 5, which was actually steep because the curve wasn't inverted like this, it was more like this. Additionally, it's a little bit harder when the 5-year is above the 2 and the 10 to really fully understand or articulate that this is a recession or something like that. The 5-year relates a lot of times to term mortgages. It can relate as well to corporate debt. The fact that the 5-year is trading above the 2s and the 10s probably indicates more that there's something going on in that trading dynamic on the 10-year than it does that there's really this massive inversion and we need to be more careful, or that the tail is going to wag the front, which is not usually the case to begin with. But you know what? It's a weird market and anything can happen. I'd also remind people as well, a dynamic that we know to be the case because the Fed chairman has discussed it more than once, is that we do have a lot of foreign buyers of US debt right now. And that is because there is massive concern about some of the other currencies that are going on, as well as generalized political uncertainty. The US dollar is still very, very strong. And so it is the case that some countries would rather own our debt so they could be paid a cash flow in US dollars. So it's possible that that's actually creating that kind of format in the yield curve. It's really hard to know, and in fairness, bond stuff is quite complicated. So if you have to ask questions down below, please do. Now, what that might imply to your bond portfolio, I'm an equities girl. I do options and stuff, so I stay in my own lane. But what it does mean for me as far as the bond markets go is, first, what's going to happen as relates to what companies report when it comes to how do they want to manage their financing. And that should impact any company that has heavy CapEx that is debt financed. There are a lot of companies that have CapEx that is financed through the equity markets, equity issuance, or alternatively, they just have a ton of cash, so it won't matter. Additionally, I care about the debt markets as relates to how will my financial companies report, because the financials will be reporting this week. Hopefully I'll get this video out in time. We will see who reported what and how did it impact them. A lot of the home builders have reported, and I'll be watching for what they say over the coming months, as well as what the REITs have to say as well. They are slightly impacted because they do a fair amount of construction lending, and the 10-year would actually matter to them. That said, I think overall rate increases are probably where they're focused on, but you never know what they're gonna say until they say it. So in summary, the front part is what we care about the most, those first 18 months. But we like to look at the whole thing, and kinked and twisted, it's not great, but if we can kind of understand why it's kinked and twisted, it might not be so bad. That's all I have for this episode. If you've got questions on this topic, please put them down below. Don't forget to like, share, comment, and subscribe to my station. Take care.